Welcome to the Scientific Sense podcast, where we explore emerging ideas from science, policy, economics, and technology. My name is Gilles Hilary. We talk with world's leading academics and experts about their recent research or general areas of topical interest. Scientific Sense is an unstructured conversation with no agenda or preparation. We cover a wide variety of domains where new discoveries are made and new technologies are developed on a daily basis. We are most interested in how new ideas affect society and help educate the world how to pursue a rewarding and enjoyable life rooted in science, logic, and information. We seek knowledge without boundaries or constraints and provide unedited content of conversations with researchers and leaders who love what they do. A companion blog to this podcast can be found at scientificsense.com, and this podcast is available on over a dozen platforms and directly at scientificsense.net. If you have suggestions for topics, guests, and other ideas, please send them to info@scientificsense.com, and I can be reached at gil@epen.info. My guest today is Professor Gilles Hilary, who is Professor of Accounting at Georgetown University. He's a founding member of the Circle K2, a French think tank on risk management. He is also a research fellow at the French Military Police Academy and a senior fellow at the Asian Bureau of Finance and Economic Research. Welcome, Gilles.
Well, Gil, thank you very much for your invitation.
Yeah, thanks for doing this. So I want to start with one of your older papers from 2008. It's entitled, Does Religion Matter in Corporate Decision-Making in America? You say we examine how corporate culture influences firms' behaviors, and more specifically, how the level of religiosity in a firm's environment affects its investment decisions. And you focus on the US here to minimize any legal and economic environments. So what did you find in this paper?
Right. So part of my research is behavioral in nature, right? And so that's one example of that stream of research that I'm engaged in. So this is co-authored with Kai-Wai Hoi. And so we were curious to see if the environment in which a firm is operating is affecting its operation. And more specifically, if like the type of people you're interacting with will affect the corporate culture of the firm. And so what we did in that paper is that we got some data on how religious a given county in the US is, right? So how many people would go to a place of worship. Now, since it's the U.S., it's typically a church, but it could be any type of place of worship, like a mosque or a synagogue or any other place of worship. And then we looked at what the literature in psychology is telling us about the link between religiosity and risk aversion. And we found several papers that focus on experimental evidence, suggesting that there is a positive link between the two, like religiosity and risk aversion are often correlated. And so what we did in that paper is we looked at whether that extend to communities. And we find indeed that when a firm is located in a place, in a county, where a lot of people are going to a place of worship, then that firm is much more risk averse. Doesn't invest as much, the cash flows are less volatile, and so on and so forth.
Right. So religiosity defined as the proportion of people attending a religious institution like the church or the mosque.
That's right. Yeah, in the county. So not necessarily people in that particular environment, in that particular organization, but people in the county where the firm is located.
In the county. So this is a U.S. study.
wouldn't you get into some regional issues? Perhaps I don't know this precisely. Certain parts of the U.S. Appear to be more religious compared to others. So would there be some sort of a geographic bias that might get into it?
Right. So I'm going to answer your question, but before I do this, we actually conducted an experiment as well. It's not the core of the paper, but we gave people two texts to read, one on cathedrals in the European Middle Ages and one on modern architecture in the US. And then we give them a test, and we ask them, essentially, will you take risky gambles or safer bets, right? And what we found was people who were prime, people who read the text about the cathedrals, were more likely to take the safe bet. Now, that experiment was conducted in Switzerland. So it's not necessarily just a US thing, right? So it's a human thing, but we focus on the US. Now, to address your question, we try to control for everything we could think of. And I'm not sure we want to get too technicals here, but we use like fixed effects, county fixed effects. We control for where the place is located, where the business is operating, what type of business we're talking about. All the thing we could think of, right?
Yeah, so control for all those things that might affect this finding. And so, if I understand this correctly, Joe, so your hypothesis here is that when you have higher levels of religiosity in a county, they seem to be more risk averse, and that risk aversion, higher than average, let's say, should lead to some sort of economic or profitability metrics we can see at the firm level.
That's right. So the bigger point was to try to link the environment in which a firm is operating to its corporate culture. But to make the question more concrete, more specific, we linked the social environment to the behavior of the firm in terms of risk-taking, in terms of profitability, and things of that nature. Yes.
Okay. And so, I find this very interesting, Joe. So if the risk aversion is higher, firms would then require a higher rate of return on their investments, right?
That's right. So holding the investment set constant, you would expect those firms to invest less. And that's what we find.
They will invest less. So their discount rate is higher. And so projects that might turn out to be NPV positive elsewhere, in these firms will not be taken up because they will have a higher discount rate for their cash flows.
That's right. But our listeners shouldn't infer from this that this is a bad thing, right? This is a preference, right? So so some communities have a preference for taking more risk, and on average that generates more rewards, but also creates more failure. And some communities have the opposite preference, right? So what you're saying is absolutely true, but one should not infer that it's a bad thing from that.
Yeah, so I was thinking, Joe, so when we look at the US, there are pockets of high activity in startups, high risk, type high technology, biotechnology, and so on. They appear to be highly concentrated. And I'm thinking Silicon Valley, I'm thinking Cambridge. Is there any connection there between that and this?
That would be a natural hypothesis to test, but we have actually not tested this in that paper. But that would seem like a natural extension to this paper. Yes, you're right.
Yeah. Okay. And so for larger firms, if we take sort of R&D intensity, you will see that lower too, right? These firms would focus on more cash flow type businesses.
So any type of investment, being it in tangible assets or in intangible assets like R&D, would be subject to the same effect. And yes, you would expect, you would see actually less investment in R&D as well.
less investment R&D, and this would be especially worse if the R&D is long-term, I would think.
Right. So the more risky the R&D is, so, you could go for a moonshot, or you could go for things that will, marginally improve your production process. So we don't test that in the paper, but you would expect that the more risky R&D project would be more affected by this, yes.
Yeah. And then you note here that the long-term growth is also lower. So all these point to a much more conservative investment stance. And data is showing that when you have higher religious subscription, that's what we are finding, right?
Right. So when the environment is more religious, controlling for everything else, this is what we find. Naturally, it's on average results, right? So like any results, you can find counterexample, but on average, this is what we find. Yes.
And they're statistically significant, you say here. Another observation here is related but somewhat different. You say we document that CEOs are more likely to join firms with similar religious environment as the last firm when they switch employers. So could you
Sure.
explain that a bit?
So again, the premise of the study is to see if the environment of the firm is affecting the culture. And we had a follow-up hypothesis, which was that some managers are going to be more comfortable operating in certain environments. And so the way we looked at this secondary hypothesis here is by saying, okay, suppose you were an executive at a firm and you leave that firm for whatever reason and you join another firm. Is the environment that you leave a predictor of the environment that you join? And indeed, that's what we find. So looking at the religiosity of the environment in which you used to be an executive is going to predict the religiosity of the environment in which you're going to operate with your new employer, with your new firm. So there seems to be a clientele effect, right? Some managers are comfortable in more risk-averse environments, and others are less comfortable. Again, nothing wrong with one or the other. It's a preference.
It's a preference. And would it also indicate that the CEOs in more conservative firms tend to switch jobs less? I know that you didn't look at that, but I wondered if that was also true.
That's an interesting hypothesis, right? So if indeed there is a greater risk aversion, you might change jobs less often. But I don't know if that prediction is supported by the data.
Yeah. What is your what is your thinking? Why is religion forcing risk aversion? What is
Yeah, so at the individual level, there has been some studies in neuroscience, and I'm probably not the right person to do justice to those studies, but it's possible that part of the brain that is associated with both risk aversion and religiosity might be activated at the same time. So that's, the small experiment that we conducted. When you read about religious buildings, you become more risk averse. And we did that in a room, and if you were sitting on the left, you got one text. If you were sitting on the right, you were sitting on you got the other text. So it's totally random. So there seems to be something in the brain that flips or that is activated when you think about religion. The exact mechanism, I'm probably not the right person to do justice to explain this in great details.
Yeah, it's really interesting, and the counter example they could also be looked at, right? So I wonder if we can show that atheists are much more risk-seeking or anything like that. Do you have seen anything like that?
No, so it depends a little bit like how you define atheist, right? So if you define atheists are people not going to church, then that's the complement of what we have, right? But if you define atheists are people who have like affirmative beliefs in the non-existence of God, then I'm not sure. It is possible that if you're an atheist, but you read a lot about religion, for example, that you might end up being risk averse as well, right? So it's not clear if it's the belief itself or the exposure to the topic that is affecting the preference.
Yeah, that's a good point. So what we're really looking at is really the process of adherence to religious norms and religious conventions. I don't know this, but we cannot really assume that people who go to church are necessarily religious. Maybe they're going to church for other reasons, perhaps for community, for other things. So I wondered if there is a distinction between religious and then adhering to sort of the religious norms and conventions.
That's certainly possible, and again, it might be also the exposure to religious topics, right? So if you go back to the experiment that we did, we have no reason to believe that people who read about the cathedrals were more religious than the other half of the room, right? But they were exposed to religious materials, and that affected their preference. So I don't have any evidence for what I'm going to say next, and I certainly could be wrong, but I'm conjecturing that it's actually more the exposure to the religious subject more than the belief themselves that is generating the effect that we identify. And that's also why, looking at the community level kind of makes sense versus looking at the individual practice of the people working in the firm.
Right. Yeah. Yeah. I mean, the neuroscience angle is very interesting. It's almost like I don't know anything about it, but it's almost like there's some sort of a fear or more sensitivity to fear, more sensitivity to risk, and that seemed to translate right across different decision-making processes.
Right. So, my training is in economics to a large extent, and, we tend to take preferences as exogenous, right? So they are given by, Martians or, someone somewhere. But of course, in reality, that's not the case, right? Those preferences have to come from somewhere. And some extent, that's what we do in this paper. We looked at where the preferences are coming from, right? So, and economists might say we are endogenizing the preferences, right?
Right. Yeah. Yeah. You have you have a working paper on trust and contracting. And it's somewhat related, but you're focusing on trust here in the community environment. And you said trust is a complex concept that has been examined by many scholars from different disciplines using various settings and methodologies. For the purpose of the study, you say we use a construct that emanates from economics. So you're looking at trust and sort of the cost of contracting.
Yeah. So that's so first of all, that paper is co-authored with Sterling Huang, and we kind of looked a bit at the same topic or broad topic, like to what extent are community norms, community features affecting the behavior of economic agents and in this case of firms, right? But instead of looking at religiosity, we look at a trust, right? So we define trust as the subjective probability that someone will help you, or at least not hurt you. And again, we look at trust in the community as opposed to trust within the organization. And what we find is that when people tend to trust other people more, you can use different types of contracts to manage firms, right? So our listeners might be familiar with the notion of incomplete contracts, right? So an incomplete contract essentially, and I'm not doing justice to the concept, but that says essentially, do the right thing and I will reward you. As opposed to saying, okay, if you do exactly that, then I will do exactly this. And so if you can't rely on those contracts, that's nice, because you can use the knowledge that the manager, that the executive has of the situation to let him or her doing what's right. And so if you can trust that person to do the right thing, then this is better than telling the person what he or she should be doing. And that's essentially what we find. We find that in counties where people trust each other more, firms tend to use a flatter contract, so something closer to a salary, as opposed to we give you bonuses or stock options if you increase the stock price. And loosely speaking, that works better. We see that those managers don't waste resources as much. And they tend to deliver greater value for the shareholders.
Yeah, it's interesting, Jill. The early theory of the firm, Ronald Coase and others, was about minimizing the cost of contracting, cost of transactions more generally. And in the gig economy, we don't really have needs for big companies in the future. And so this is becoming more and more important.
I think trust is fundamental. Right? I think it's a huge asset for a country, for a culture, for a company. If you enjoy it. Now you can cultivate it, but sometimes it's sort of given to you by history or something that you have no control over, and when that's happening, then that's a great advantage for that culture. Unfortunately, and that's not the paper, but that's more personal belief, I think trust is becoming harder to sustain, at least at the community level these days, for a host of reasons.
Yeah, as they say, it takes a lifetime to build trust, but you can lose it in one transaction.
Right. And there are also like broader technological and social evolutions that are, impacting cultures, and maybe not for the best in terms of culture, in terms of trust.
Yeah, and I also wondered, in a society that is more prone to legal maneuvering, let's call it that, whether you can really change the culture to be more trustworthy. Maybe the initial conditions are so bad. I wondered if it's even possible.
It is challenging. It is challenging. I mean, it's not really what we do in this paper, but other people have shown that there are deep cultural effects. So some culture are, for whatever reason, more trusting than others. And that effect can last for generations, right? So if you look at the level of trust in the countries from where people immigrated to move to the US, so it could be in the 19th century, you see that in counties where that particular group of people is located today, is still affected by the trust from the past, right? So if you have a lot of Swedes in one area, and Sweden, I think immigration from Sweden was in the 19th century, if I remember correctly, in the US. So if trust level was high in Sweden at the time, then counties where those folks would move to would still have a high trust today. And conversely, if you're immigrated from a country where trust was low at the time of immigration, you can still find the effect on the local culture in the US century later.
Yeah. You say in the paper, we hypothesize that the level of trust commonly observed in a given community affects the way firms located in that community behave. This is very analogous to the religiosity we just talked about. So there is a property of the community in which the firm is based, and the firm behaves in a certain way given that property. But then you're looking at in the paper within organizations, right? And so sort of the interplay between organizational culture and the community in which the organization is based.
That's right. Yeah. So we look at contracts again. We looked at the type of investments, the economic performance, again, conditioning on the environment of the firm. So to some extent, the two papers are speaking to each other. Perhaps one difference between the two is religiosity is something that doesn't evolve too much, right? So it takes a while before cultural norms or cultural practices would change. But in the trust paper, we also looked at a sudden shock to trust, right? We looked at what happened when community leaders are misbehaving and what that does to trust, and that's not good in a nutshell. So we couldn't do this in the religiosity paper.
Was there any? Did you look at any sort of firm performance against?
Yeah. So what we find is that the performance of the firm is higher when it operates in environments where more people trust each other. You waste less resources trying to maximize you being the executive, maximize your own welfare, and instead you end up doing what's right for the company.
Yeah, I was thinking that because people use trust as an important proxy for decisions, it has a downside because if you look at financial markets like private equity or venture capital, people tend to invest in others that they know from previous transactions. So it has the net effect of perpetuating a small group of people getting capital than others, because if you don't have the initial conditions, it's really difficult to break into it.
And the less trusting community or culture is going to be, the more the effect that you describe is likely to happen.
Yeah. And then I would imagine the CEOs have a big effect on the firm culture too, right? I have seen some large companies culture change in a matter of months with the change of the CEO.
Yes, could be. So when I teach about those issues in class, I often talk about a company called Tyco that no longer exists now, but was caught into a scandal, and there was a new CEO who was brought in, and he completely changed the culture of the companies within a few months, right? But he had to change the leadership to a very large extent. So you're right, but one would have presumably to take fairly extreme measures, like the gentleman who came to that particular company, changed the leadership. I think like pretty much everyone in the top 100 of the firm moved on, if I remember correctly. A very large proportion of the leadership was changed.
Yeah. And you mentioned this. So one of the things you examine in the paper is the effect of a sudden negative and exogenous shock on community trust caused by misbehavior, you say, by leading representatives of moral authorities. In this case, you're looking at the sexual abuse by Catholic priests. So what's the conclusion here in terms of an exogenous shock?
One issue when you're a researcher and you look at the culture of the firm is that you're dealing with what is known as endogeneity, right? So you don't know what are the causes, what are the effects, right? So when you do this type of research, what you're trying to do is to find a shock that is clearly coming from the outside, right? And so here we wanted to have a shock that would affect community norms, community beliefs, but that would not come from the behavior of the firm. And so we focused on Catholic counties, and we looked at what happened when there was the revelation that many priests had abused different people, but children in particular. And that obviously came as a big shock for many Catholics, right? And so what we found was two things. One, that shock negatively affected the trust in the community. So people started to trust each other much less. when the scandal was revealed. And in turn, this drop in community trust affected the firms located in that community. And so the advantage that some of those firms held, because they were located in counties where people trust each other, kind of lost that advantage when the trust dissipated.
Yeah, that's really interesting. So this property that a community has, it's highly nonlinear, it's highly interconnected, and it is not really firm specific in any way. It's really a property of the community, and that can get destroyed for many different factors. None of that
That's right. So
so
we're absolutely not saying that trust within the organization is not important, right? But it's much harder for researchers to show that it does matter in a causal sense, because the performance of the firm and the culture of the firm and the type of executive that you have, all those things are highly endogenous, right? They are co-determined, right? So trying to disentangle one from the other is challenging. So instead, what we did was to focus on community norms, right? And we did different things to ensure that the community norms were not affected by the behavior of the firms that we are looking at, right? One of the things was to look at this shock. And so to that aspect, you're absolutely right. It's not something that firms control. That doesn't mean that there aren't some aspects that the firms could influence.
Yeah, I was just thinking, Jill, that if you look at small countries, and if there's some sort of a bad thing happening, it could have not just sort of community-wide or a few firm effect. It could have a macroeconomic effect, right?
Absolutely. I mean, smaller communities, smaller countries are going to be more susceptible to be affected by a specific shock, right? Because you can't diversify the consequences as much. But smaller countries might also have a more homogeneous culture, right? So when there's a shock to the culture, then that shakes that country more deeply than if you have a broader country. Now, of course, this is everything else equal. Some countries are very fragmented, and in spite of being small, other countries, in spite of being really big, are relatively homogeneous, right?
Yeah, I mean, people have sort of this country risk factor when they make investment decisions, and this is sort of a systemic factor, right? So let me let me make a statement. You can correct me if this is cannot be true. If a culture is more homogeneous, if the country is small and the culture is homogeneous, the country has higher risk because it's very brittle in the sense that it will be very prone to a shock that could substantially change its
So
culture,
I don't know
really.
if what you're saying is true, but I think that's certainly possible, right? At the same time, if you're more homogeneous, you might have a more resistant culture. One thing that I always find depressing is that one thing that would negatively affect trust is the heterogeneity in the population. So we tend to trust people who look like us. And so when you've got more diversity, there's often less trust. Now, don't get me wrong, right? Diversity also brings like many advantages, and I could see the benefits of diversity, but there is also a cost in terms of trust, right? And so a smaller, more homogeneous country might have a more resilient culture to shocks, but it cannot diversify them. So I don't know where we end up with this, right?
Yeah, it could also be a handicap of our generation, John. And so when we say we have higher trust in people who look like us, it's really a remnant of the past. For the next generation, it's a very different thing. What they mean by somebody who look like them is somebody who communicates with them over the web or in social media. in a way they can actually internalize. So I think we might be changing.
So it's possible, right? But you could imagine some evolutionary functions that have led to this, right? So like, people from other clans might be more likely to be hostile, and so you trust people from your clan, right? Now, of course, the point that you're raising, which I think is a very valid one, is how do we define clans, right? So back in the days, where people living close to you would look like you, right? But in the modern age, how you define someone who looks like you might be different, right? Maybe not physical appearances, but maybe more like the behavior or the beliefs that this person has, right? That remains to be seen, though. I think those factors have been there for a long time, and I'm not sure if that aspect will disappear in the near future.
Yeah. We'll take a quick break, Gilles. When we come back, we'll talk about a couple of your other working papers. Thank you.
This is a Scientific Sense podcast providing unscripted conversations with leading academics and researchers on a variety of topics. If you'd like to sponsor this podcast, please reach out to info@scientificsense.com.
So we're back. Gilles, we were talking about properties of communities where firms are located and how those properties actually affect firm performance and firms' decision-making, properties such as religious intensity, trust, and so on, and how those things could be changed by external shocks. You have another working paper, which is in some sense related, Self-segregation and labor movement, in which you explore the relevance of a well-established theory in social psychology to self-segregation by examining 9/11 terrorist attacks as an exogenous shock to Islamophobia. I want to talk a bit about that paper.
Sure, happy to. So as you said, we focus on a theory that comes from psychology. It's known as mortality salience, or MS.
Yeah.
And so what this MS theory is saying is that when we are reminded that we are going to die as individual, we tend to refocus on our core identity. And what that means is going to be different for different people, because the way we define our identity might be different, right? So for some people, that might be, religious, to continue on the theme. It might be the countries they belong to. It might be the university you went to, or whatever, right? But that's essentially the idea, right? And so we applied that in the context of making decisions about where you want to work and where you want to live. Again, we're going to be focusing on executives because we got more data on this population, and I guess we understand perhaps this population better than other social groups. And so what we did in that paper is we looked at the effect of 9/11 on the behavior of executives, and more specifically where they wanted to work. And what we found was if you were an executive living in a community with a more visible Muslim presence right after 9/11, you were more likely to leave your firm, controlling for everything we can think of, and to move to a community where there would be a less visible Muslim presence. Now, to be clear, this MS theory is not a theory about the risk of dying, right? So it's not driven by the fact that you were living in New York or in DC, where the attacks occurred to a large extent, but it's more like a refocusing on your core identity. And then we have what's known as comparative statics, so things that would exacerbate or mitigate that finding. For example, you got a lot of hate groups in the community. It's more likely that you would actually leave your job. Conversely, if you got more social capital, people interact with each other more often, then you would be less likely to leave your job. So that's in a nutshell what we do here. And there's obviously a lot of interest in the U.S. and elsewhere about segregation, right? So like some group being excluded from certain part of the country, or certain services, or certain things they can do. There's perhaps a little bit less focus on self-segregation, like why a group would separate. But more importantly, I think bringing this theory to the discussion is somewhat new. The theory has been there for a long time, but people have not really examined the implication of that theory for self-segregation, and so that's what we did in that paper, or we attempt to do in that paper.
Yeah, so similar to the previous things we were discussing, so some sort of an exogenous shock to the system leads to people self-segregating around smaller subgroups of people that they trust.
Yeah, people who essentially look like them, to use a casual expression, right? So yeah. I don't mean this literally, but like people who share the same identity, right, would be a better way of putting it, right? So if you think about the three papers we have discussed, right? So the first one, we took religiosity, social norms completely as exogenous, as given, and in that context, we didn't look at things that could change that. Then in the second paper, we looked at a shock to morality as a way to change local trust. And here we looked more at the factors that may affect the type of people who live in community and would leave this community, right?
Yeah, I have a very cynical thought, Jill. If a politician were using this as a strategy, then the politician requires exogenous shocks to the community at some regular interval.
Right, but if you conjure images of death on regular basis, you might actually get the same effects, right? So if you're running political ads with a death angle, for lack of a better word, you may have a situation where people refocus on their core identity. And depending on the political situation, that may or may not be to the advantage of certain politicians, right?
Yeah, such a politician wants to keep people afraid, and it has to be sort of a continuous information flow that will, sort of conditioning the community to be afraid, and that has beneficial effects in some ways.
It could have beneficial effects for the politicians, yes.
Yeah, for the politicians, I mean,
yeah. Yeah.
So I want to move on to a couple of your other papers. One of them is mandatory data breach transparency and insider trading. You said using the standard adoption of state-level data breach notification laws, we examine whether mandatory breach disclosure affects insider trading. And so I don't know much about this, Jill. So different states have adopted sort of different standards for notification.
Yeah. So maybe before I get to the details of that study, I mean, trust is something that I'm interested in, right? And I'm also interested in technology and naturally the interplay between the two, right? And so technology has a lot of effects, some good, some bad, but there's going to be a need to regulate somehow the development of technology. And I believe probably the best way to do this is through social norms, but that's hard to change, as we discussed, right? So then you probably need some legislation, some legal elements to do this. And so that's what we kind of looked at in this paper with two other co-authors, Xiaoni Tian and Qi Chen. We essentially looked at a piece of legislation or a series of legislations at the state level that essentially says, well, when there is a breach, if you're an organization and there's a breach that is material, and materiality is not always defined exactly the same way, you need to do something about it, and usually that means you have to tell the public about it, right? Sometimes the authority, sometimes the public, but usually the public, right? And so that sounds like a good idea. And we wanted to see, okay, is this working, or can we have some adverse effect coming from this? And so the way we thought about it was to focus on insider trading, right? So as you know, insider trading is a situation where insider executives, for example, have some information, and they buy or they sell stocks of their own company based on this information. It is often illegal, but not always. So there are ways you could legally trade, using information. And so we wanted to see what's the effect of this law, because these laws are not designed to protect investors. They are designed to protect consumers and citizens. And so what we found in the study is that when the law is really strict, then firms end up investing more in cybersecurity, and you don't see as much insider trading as you saw before the passage of the law. But when the law is not that strict, instead of investing more, executive trades on the risk of future breaches. And so that's one of the negative effects of this law. And we thought that was interesting because, if one is not careful, like the law designed to protect a certain type of people, consumers here, might end up harming other people's investors in this case, right?
Yeah, so I'm thinking that there's some sort of an optimization, right? So regulation has cost, and generally, if it is compliance type regulation, it doesn't really add much economic value to society. So there is an optimum level of regulation that I'm just making a statement. Correct me if I'm wrong, Joel. There's an optimum level of regulation that extracts the right behavior from the firm, and you have to keep it there, or something along those lines.
Yes, I think that's generally true. Now here we're not making a statement as to whether those laws were good or bad, right? Because I mean, on the one hand, when they're really strict, you see more investment, so consumers and citizens are protected. You see some negative effects when they are weaker, and we don't speak about the cost to the firm. So we're not saying it's optimal or suboptimal, right? So it's not so much the level we're considering in this study. Not saying that your point is not valid, but that's not what we look at. Rather, the point we're trying to make here, the broader point we're trying to make, is that one has to be very careful when you use this type of laws, because they can actually make things worse, because you're changing the behavior away from what social norms might have suggested people to do, and if you're not careful, you're going to end up in a worse situation.
Yeah, it's if the objective is to reduce the likelihood of a crash, you call this vehicle loss lead to an increase in idiosyncratic crashes. Some sort of discontinuity, some rogue trader or something along those lines that essentially takes a firm out, a big discontinuity, as opposed to sort of small problems going on that doesn't really surface because they are small, but it is continuous. So I wondered, the laws and the cyber-related investment are two different things for these two things, right?
Yeah, so the law does not mandate that firms should invest more. So each law is different, but I'm going to speak of the laws as if they were the same. What they typically suggest is that you tell the public about it, right? So you're imposing a cost to the firm when there's a breach, because your reputation might be affected, because the regulators might start looking at what you're doing. That might be other costs, right? And then sort of leave it at that, right? And so if the penalty is sufficiently large, then firms want to mitigate the risk, and they invest more in cyber investments. So the two things are not the same thing, but you see an increase in cyber investment after strict laws have been passed. When weaker versions are created, you're essentially creating an additional risk, and instead of investing, you see the executives protecting themselves at the individual level by selling ahead of the problem.
Yeah, then bonuses are more important than the firm itself. So I want to finish up with your, I think this is a book chapter, Joe, Artificial Intelligence and Fraud Detection.
Right.
You say fraud exists in all walks of life, and detecting and preventing fraud represents an important research question relevant to many stakeholders in society. And with the rise of big data and artificial intelligence, new opportunities have arisen in using advanced machine learning models to detect fraud. I did some work in this area, Jill, about 5 years ago, where we used accounting data to train a model. This is supervised machine learning. So we have past instances of fraud actually happening, and we have accounting data when fraud happened or did not happen. And such data might be useful to train a model that can be then deployed on emerging accounting data to assign some sort of a fraud score to that data. You're talking about something along those lines here?
Yeah, so that particular piece co-authored with Yang Bao and Bin Ke, and it's, as you said, it's part of a book where I'm the co-editor with Vlad Babiš and John Berger, who I think were on your podcast in the past. We in the book look at the interplay between operations, finance, and technology. And so, the first papers we talked about were more about regulation through social norms, and then the last one was more regulation through, the legal aspects. This one is more practical things one can do using tools, right? And so, we try to discuss the advantages and the drawbacks of using new technology, artificial intelligence. It's really machine learning. We call it artificial intelligence because that sounds more sexy, but it's really more machine learning. But we try to be fairly objective, right, in the sense that any other new technologies, it brings good things and bad things, right? But you're absolutely right. So one thing that you can get out of this technology is the estimation of some sort of score that will predict the likelihood that there's some sort of fraud, and in particular accounting fraud, right? So yes, we're looking at, that's one of the things we're looking at.
Yeah, and the other type of machine learning you could do on accounting data, as you know, is unsupervised machine learning. So, again, we can use these techniques to look for patterns in the data. And even if you don't have an ex-ante expectation of fraud in those patterns, that those patterns could be interesting to further analyze, right?
You're absolutely right. But that's contingent on, at some point the fraud has to be revealed, right? Otherwise, it's going to be very hard to use unsupervised techniques, right? So if you think about credit card, right? So most frauds will be detected eventually because, people see their bank statement, see that, they've been billed for something they haven't bought, they call the bank, and, so it might not be caught on time, but it's eventually caught, right? Accounting fraud, it's harder, right? So the SEC, the regulators will catch some of those cases, but not all of them, right? And then if you move to something like, anti-money laundering, for example, right? The proportion of bad things that is caught is probably way smaller, right? So you're absolutely right that one could use unsupervised techniques, but I think it depends on the type of fraud that you're dealing with, right?
Yeah. So in conclusion, Joe, going back to the few papers that we discussed, there's sort of a common thread in the papers, as you said, you are very interested in trust, sort of a common foundational aspect. But we talked about religiosity, we talked about other things in the community that affects the firm. There is also a trade-off here, right? So if the firm tries to cultivate trust by reducing diversity, as you mentioned, it has a downside, obviously. It affects the firm's performance in many other dimensions. And so what's your general thoughts on that from a design of the firm perspective looking forward?
Right. So this is obviously a very sensitive topic at the moment, right? Diversity in the U.S. and I guess outside the U.S. is something that a lot of people are talking about. There are a lot of research articles that have shown the benefits of diversities for the organizations, right? And I generally agree with the findings of those studies, right? Perhaps what we have spent less time collectively looking at are the cost of diversity, right? So that's probably happened for a host of reasons that have nothing to do with academia, but the broader world, right? That may be the next step, right? So like trying to understand what are the cost and the benefit of diversities from the point of view of the organizations, right? It might be the conclusion that diversity brings so much benefit that when there is a cost, it's cost of doing business essentially. But I'm not entirely sure we have established that yet, right? So hopefully, in the years to come, then people will look at this and get a better sense of what's the best way to deploy diversity, if you will, right? How do we achieve greater diversities, but when the benefits are maximized, right? Now, of course, that's from the point of view of the organizations. Society at large, individuals might have different benefits. We might be in a situation where it makes sense to force organizations to be in a position where they don't have the optimal level of diversity from their point of view because it makes sense from society point of view. But before we get to that point, I think we need to understand the benefits and the costs for everyone.
Yeah, it's there are two types of diversity, I think, right, Jill? So, in 2009, in one of my books, I argued that in the future, there will be no firms, there'll be only individuals. So we, sort of the extreme gig economy where the definition of the firm is not static. The firm is the individual. And so the diversity there is really in transactions. How does that individual transact externally? And there, diversity is almost a necessary condition for that individual to maximize profits.
It's possible, but I'm not sure it's necessarily obvious, right? So there's no discussion that there was an increase in the gig economy over the last few years, right? So that's only a fact. And that happened because people saw the benefit of doing this, right? But I think people are starting to see the cost as well, right? Like anything, it has cost and benefits, right? And so that type of organizational paradigm might be growing or might be decreasing in the future, right? The role of diversity in that sense is going to be interesting to look at, right? There's going to be more communication between people from a technical point of view, but then we will be probably dealing with cultural challenges that we touch on today, right? And so it's not because you can talk to more people that you end up talking to people who are more different from yourself, right? If you think of TV in the US in the like 60s or 70s, whatever, you have a few network channels and pretty much everyone was watching them and they would speak to the middle of the road. But then when cable appeared and internet appeared, then you saw that the networks got more and more specialized, right? And so you might actually lose diversity because it's easier to communicate with people.
Right. Yeah, it's a moving set of variables: firm size, transactions between firms and individuals. What exactly is a firm, multinationals, all sorts of things. So it's a moving target.
Yeah, exactly right. So, sort of continuing with the theme of our conversation today, you got the interplay of cultures, broadly speaking, the law, and then technology, right? And technology firms today are powerful enough to affect social norms and certainly to affect the legal aspects, right? And so it's a very complex situation to understand, but it's probably what's defining our time at the same time, right?
Yeah, exactly. Excellent. Yeah, this has been great, Gilles. Thanks so much.
Thank you for the invitation. It was a pleasure, and I hope your listeners will enjoy it as much as I have.
Absolutely. Yeah. Thanks so much.
Bye.
Bye.
This is a Scientific Sense podcast providing unscripted conversations with leading academics and researchers on a variety of topics. If you'd like to sponsor this podcast, please reach out to info@scientificsense.com.